Okay, I think we have everyone. Leland's going to join us here a little bit later via Zoom. We've got Paul, Leanne on Zoom. Everyone else, welcome. Good morning. You see no one from public here. So first order of business is approval of the minutes from our March meeting. We'll move it. Second. Any discussion? All those in favor?
Aye.
Any opposed? Any abstain? Okay, thank you. I'll turn over to Janet.
Thank you very much. Good morning, everyone. So our pension payroll report for this month, our April 1st pension payroll for the town PD and Board of Ed, we had 99 retirees for a gross payroll of $161,556. That was no change from the March payroll. We have one QDRO spouse for 100 total participants. The fire department plan, we have 38 retirees. Gross payroll was $16,799. We had one new retiree. Now we have one QDRO spouse on the fire department for a total of 39 total participants. For our pending retirements, next month, June 1st, we will have two new fire department retirees, past Chief Vernon Scow and Robert Vanderhorst. And then later in the summer, on August 1st, we will have a middle school custodian with 12 years of service, George Tasillo.
Don't we have one more pending retirement?
Well,
Don't we have one more pending retirement?
Yes,
Well,
later. Little
September, isn't it?
September.
no, I just, okay.
Yeah, September, October will be the first payment.
Well, first payment will be October 1st.
Yeah, and there were several other announcements. Like, I don't know if any of them were defined benefit. Mary Lou Sunday
No,
and Gardner's already doing
Already.
it, and
DePerry's
and
already,
Coco.
nope, he's part-time.
Okay, all right, so there were kind of, we got a blast the other day, dated April 5th, but received April like 22nd, that multiple people are retiring, which, given the change, is probably a good thing, right? I mean, that's the way I'm looking at it. Change is good, and you know, there'll be a lot. New chief will be able to put in his new people, you know, so. It's kind of,
Thank you. Sorry for interrupting you.
no, good question.
Good. Any other questions, comments? Anyone online on Zoom? No? Okay, turn over to,
I think I interrupted you before you got to the other plan.
Sure, I'll be happy to share the information about the DC and the DB participants. As of our payroll on April 11th, our defined benefit plan had 47 contributing town employees. We will have one new police officer to start contributing in October. Our Board of Ed has 20 contributing employees. Our defined contribution plan has 45 town employees and 29 Board of Ed employees. And 76 of those DC participants elect the extra employer match.
okay, good. Questions? Okay, I'll turn over to Kevin.
Right. Interesting time. So I was just saying, you know, like sometimes it felt like coming every month there wasn't a lot going on between month to month. And now I'm very happy we come here every single month because things literally change, you know, by the hour. I was saying earlier, just yesterday, okay, within the last 24 hours, Trump said that he was going to not have such a hard stance on China tariffs and could possibly reduce them. And then his White House spokesperson came out and said, no, that's not true. We're going to keep the tariffs at 145%. Then he came out and said he's thinking about raising taxes on those making over $1 million.
I didn't hear that.
To help, you know, offset some of the tariff issue. And then within 2 hours said, no, he wasn't thinking about doing that. This is all within one day. And so if you turn to,
So what did the market do yesterday?
the market was up yesterday.
Okay.
It's gonna be down today, it seems like, but a lot of it is on optimism from, some comments made at a conference, earlier. From Trump's economic advisor that said that, we would be reducing a lot of the tariff stance, right? Which we have yet to actually see, all right? Let's just keep that in mind. So I think the best place to start would be like page 9 of the perspectives here. I think this really puts things into perspective. Left-hand chart. US economic policy uncertainty index is at an all-time high. Think about how uncertain things were during the beginning of COVID. Okay, the world was shut down, right? We had no idea when the world was going to reopen. We had no idea what the virus was going to do. Think about how uncertain things were during the great financial crisis, okay? Is the banking system even going to survive? Is there going to be a stock market? Basically, things are more uncertain today than they are during those two times in our history. Stock market collapse in 1987 doesn't even look like it even registers on this. It's wild. I don't know what else to say. It's absolutely wild, and the market is not trading on fundamentals. The market is trading on what is coming out of Washington at any particular moment. And when we look at, if we go back to page 8, just to kind of give a sense of what this correction has done and where we sort of are, right? The S&P next 12 months forward-looking PE is at 19.3 times. Right, that's a middle bar. 15-year average is 16.7. So still expensive, and that's on earnings that were expected pre-tariffs. Just, we don't know what the effect of the earnings are going to be, and how margins will decrease. So basically Morgan Stanley is saying, we could trade down as low as basically 4,800 on the S&P, maybe even a teeny bit lower. It seems like it's going to be a slow grind lower. Okay, you have like a lot of, down and then some up days, and then it kind of whittles back down, and then you get some up days. We could be in a situation where, from 2000 to 2003, right, the market fell 50%, but it took 3 years to get there, right? So this might not be a very dramatic, it might be nuances here and there on the policy, but we have really no policy agenda coming out of Washington at all. So it's very difficult to sort of, for companies and for investors alike, to try to determine on what's going to happen as we sort of move forward here. We want to turn to page maybe 27 quickly. Again, the equity market continuing to beg for rate cuts here. Expected Fed rate cuts now are around 3 to 4 times, and January 23, 8 times down to 3, and back up to 8, 10 at the in fall of last year, down to 1. Morgan Stanley is still saying no Fed rate cuts. Maybe we'll have a surprise one in June, July, depending on if there is a recession, how severe that recession would be. But as of now, no Fed rate cuts. Another issue that Trump has decided to, change course on. He wanted to fire Powell one day, and then the next day, no, Powell's going to stay.
Is your team projecting a recession?
Right now, we have a 40% chance of recession. Personally, in my experience, I think it's going to be a lot higher. Just because capital is frozen, right? Global capital is frozen right now. You cannot move goods because of tariffs, and people are not willing to pay those extra higher prices, because they're not here in the US, because the consumers extended. People aren't building things.
That's why he backtracked on all that stuff after he met with the Walmart, like for Target, the executive CEOs from.
So the CEOs are starting to, I think, show him how bad this could actually get, right? I think Walmart said, the CEO of Walmart basically just said, we're not gonna have any goods to stick on the shelves. We're not gonna be able to import anything to put here to sell to anyone if you have these tariffs. I think, part of the issue is that, the tariffs quote unquote worked during his first term, because he put some tariffs on China. Goods still came in, you know, and he did see some revenue. The problem is you can't just blanket tariff every single country and expect the same outcome from every single thing, especially at much, much higher rates. So you can see that on, you know, page 28. Go to the next one. Earnings estimates are starting to roll over here and come down. And they can come down, you know, a lot depending on how long this goes on. This tariff war goes on. Any thoughts or questions?
I mean, when's the next inflationary index? Like, when are they gonna have a beat on what's happening with inflation?
Yeah, so it comes out every month, you know,
Are they
typically.
seeing anything?
So inflation's actually kind of come down a
Well,
little
it
bit.
has come down.
All right, that's because energy is a big part of inflation. And oil prices have come down, not because we're producing more oil, but because the economy's slowing down. People aren't, you know, traveling as much. You're seeing a lot of airlines, you know, cut routes. You know, so that's not a positive, I'd say, economic situation, right? In a positive situation, you want oil to be just high enough that it's profitable for the energy companies to drill and produce, right? But not expensive that it kills the consumer when they're, right now, we're in a situation where the energy companies do not want to produce more at all. They've kind of, you know, backtracked from that, but it is certainly helping the consumer a little bit.
But as far as, I'm thinking, I mean, we talk about the global national issues, but as far as the plan, you know, if you have a situation where inflation for goods like food and plastic items on the shelf is going up,
Yes.
the Fed, you know, your rate cuts are unlikely to come down.
Right.
Because then you end up in this weird dynamic, so that's gonna be interesting to see how that plays out, and it's obviously in some ways okay for the plan that interest rates stay a little higher because we're making money on our cash, right?
Correct, and the discount rate's a lot higher too, right? In terms of what you can say the present value of their liabilities are as well. So both of those things are helpful. I think the Fed is gonna keep rates higher for longer because tariffs are inflationary, tax cuts are inflationary. You know, we had a nonprofit yesterday who said, you know, don't you think if there are, you know, more tax cuts towards the end of the year for corporations and individuals, that could be a stimulant for the economy? And I said, you know, I think that if that doesn't pass, that'd actually be better for the economy. Because the problem that we could incur, you know, over the next 12 to 18 months is higher tariffs, lower interest rates, and lower taxes. And you can't tell me inflation is not gonna be at a, you know, 4, 5, 6, maybe even higher handle with those three things going on, unless basically the, you know, economic activity is literally just come to a grinding halt, which is also a bad outcome. So, so all those things certainly are very, very concerning and cautious, and I think the Fed has at least done a good job of not, you know, capitulating on the political pressure to cut rates at this point to stimulate economic activity. Because one, we are not in a recession technically, and two, they are at least forward thinking in the fact that inflation most likely is going to be higher going forward, and they don't want to have to contribute to that. Right, so keeping rates higher is probably on the table, you know, for the foreseeable future. You have any thoughts? Paul, come on, you gotta have something. This is like, there's too much going on for the lack of questions here.
I really don't have anything. I don't think that anybody really knows. That's kind of the bottom line where inflation is going and whether or not we should have rate cuts, whether we should be cutting rates now in anticipation of a weaker economy. But, you know, right now we're at full employment, and I agree with you that I think that it's not likely to have rate cuts as long as we're at full employment.
So one of the things we talked about too to our clients is, you know, as the Fed had 0% interest rates for a long time, there was a mantra, just don't fight the Fed, right? don't fight the Fed, they're gonna provide liquidity, the market's gonna go up, the economy's gonna be okay, everything's gonna be, rainbows and sunshine, right? Well, you can say the same mantra now, don't fight the Fed, the Fed is saying, we're not gonna cut rates. Again, the markets are begging for them to cut rates, but they're not. So if the same mantra holds true, then that would mean the equity market has to be at least somewhat weaker because they're going to hold rates higher for longer. If economic activity doesn't justify those higher rates, right? So,
But there are also issues with getting into treasuries, as I understand it.
so part of the problem now with the treasuries is that the longer dated treasuries obviously have had a pretty significant move up. They traded all the way down to around 4%, around 4.3, 4.4 as of today. And the thought is they could possibly go higher. There's a lot of people that we might even go to 5%. We got very, very close at one point, and then came down. Part of the problem that you're hearing from a lot of economists is, the safe haven of US, treasuries is now going to have some sort of premium on it, interest rate premium, because of how chaotic the agenda is coming out of Washington. So it's no longer that the US is the, best house on the block. The US is acting just like any other country would be, that deserves, more interest rate premium, right? I mean, if you're doing business with the US and lending your money, right now, I would think you'd want a little bit higher interest rates than possibly you've had in the past. And that's just because, some economists are saying like the brand of the US has been damaged. I mean, we've really done a lot of damage to our trading partners and our allies, that, wanted to lower rates in the past, and things have certainly changed. So, this also just want to quickly go over, we, last month we released our capital market assumptions. We just want to quickly go over those.
Is that a different,
It's a different, yeah. It's in the after page, tab 1, I could say. If you go to page 4 on that to start. Upper right hand side, just looking at asset class and volatility forecast. Volatility is higher pretty much in every single instance, especially in the US. Still expecting emerging market and international equities to do better over the next 7 years. These are 7-year forecasts here. And you can see that, taxable fixed income, with a, 4.8 annualized return and a 5.9 vol, looking, pretty good relative to a 6.5 and a 15 forward vol for US equities. Next page. I know I had mentioned this before, but just want to reiterate this, okay? Left-hand side on the next page, upper left-hand side, the 20 to 25% of the total return in the last 2 years, average total return, is simply because people were super optimistic about stocks and the economy. Okay, valuation metrics went up. The earnings did not. The dividend yield went down. So those two types of returns didn't contribute to the total return in the last 2 years. And I know it was to, our detriment in the way that we were positioning the plan. But generally, when you have a situation where valuation metrics go up like this, future expected returns do come down. And so even without the policy confusion coming out of Washington, I feel like there still would have been a little bit of weakness in the market, just because of where the valuations were, right? And then I think that's probably yeah. So yeah, the thought is basically, we're expecting stocks and bonds to return basically the same amount in the next 10 to 15 years. That's not to say that's going to happen. Okay, things change all the time. We have a midterm election coming up next year. That might be helpful in terms of stabilizing things. I think if we get any sort of stability out of Washington, That's a positive sign. But until you get economic activity really picking up on a global scale, right? Because we are, as much as you want to say this should be protected and we need to manufacture here more and all that kind of stuff, which is totally a sound strategy, by the way, especially from a national security standpoint, totally understand why that's possible. You can't just shut everything down to achieve that result. And that seems to be what's happening. You know, global CEOs around the globe are literally just not building new capacity, not building new manufacturing plants anywhere. Because they're very, very worried about what the future really holds. And when you look at, you know, one of the reasons I know we've talked this ad nauseum about international diversification, emerging markets, all those kind of things, right? But, you know, one of the arguments of not investing in international or emerging markets over the last 10 to 15 years was 40% of the revenues from the S&P 500 came from international because you have global companies, right? Well, now, one, those 40% of revenues are at risk because you have tariffs on them, so you have no idea what the margins are going to be. Two, are these companies not even going to onshore those profits anymore? Are they just going to keep the the profits and things offshore, which is not going to bring any production or investment into the U.S. at all? And then second, on the 60% that's in the US, obviously, we don't know what the margins and the profitability is going to be on that side as well. So a lot of uncertainty, a lot of climbing the wall of worry as the markets usually do, right? Anything else you want to add? So in terms of the, how, all this uncertainty and how we're positioning the portfolio, this is one of the reasons that, cash is about 5.5%. We actually increased cash this month, just, 2 days ago. We're probably about like 6.5%. We did about 1%. And that's, twofold. One, you're still earning something on your cash. Okay. So it's not going into something that's zero, right? It's earning about 4%. And then second, it provides for liabilities, cash payments for the pension that we could see in the foreseeable future, so that we don't have to sell things at market bottoms in case things do get worse. And then obviously we have a more protectionist sort of defensive posture in the portfolio that we've had, for the last, I'd say, at least 4 years. Post 2021, we had a very, very strong return, and then we were trying to be more protective, I'd say, for the last 4 years. And that's been helpful. So as of yesterday, and Becky will get into the performance report for the end of the month, but we were down 1.77% year to date, as of yesterday, versus 176 for the benchmark. So 1 basis point of performance, but versus 427 for the 60/40. So 250 basis points of outperformance there. For the fiscal year to date, we're still up 2.11%. Okay, that's versus the 256 for the benchmark, and 132 for the 60/40, so 80 basis points of outperformance there. So being more heavily international has helped. Being more defensive on the US equity side has helped. Having more cash and more bonds have helped. And another one of the things that we did in the last month that won't show up in the report here is we moved a little bit more. We were increasing duration. We've since now gone and decreased duration a teeny bit, not a lot, but just a teeny bit, because we're worried about longer term rates. And the way that the rate curve is right now, it's like a smile, basically. Short term rates are 4.3. They go down to 2 years like 3.9 or something like that. 5 years like 3.8, and then a 10-year now is at 4.3, 4.7. So longer term rates we feel like have a really precipitous precipitous area to be. So we wanted to shorten up the duration just a teeny bit.
Great, we can go over the report and just starting on page 4.
Of what report?
The performance
The
report.
town.
The
pension
DB.
Performance report, yeah, the
Yeah,
DB.
yeah, okay.
Yeah, pension
Yeah.
report. So Kevin gave you the updated numbers, and just, to remind everyone, this is as of end of March, so end of Q1. At the end of Q1, total ending value is 27.791 million for the town pension plan. And then if you look at the quarter to date, the return, we did outperform the benchmark as well as the 60-40. It is very interesting to note just the quarter to date. In the last row, noting the MSCI EFA was far and away the highest performer for a quarter to date for 2025 at 6.8%.
What does that stand for, Becky? MSCI?
Morgan Stanley Capital Indices. So it actually used to be a company owned by Morgan Stanley, and then they spun it off. I want to say it was probably like 20 years ago or something like that. It's basically it's like an S&P, basically. It's
But
like,
for international.
yeah.
So Europe, Africa, Middle East, Far East. So yeah, really, again, Kevin mentioned the defensive positioning that we've had. If you look on the bottom left-hand quarter of the page, our positioning here is around 60-40, so 60 equities, 40% fixed income and cash. But the weightings within those two categories are again defensive. So on the equity side, much more on the value parts of the market instead of the growth, and then on the fixed income side, much more on the short end. And obviously the cash positioned very defensively. The next page, we're very close to the benchmark. The portfolio is very, very close to the benchmark as of the end of Q1. And then we can look down on page 8 again, looking at that, the quarter to date and month to date, how we are, outperforming not only the benchmark, but the 60-40. And yeah, Kevin read through some of the year-to-date numbers and the fiscal year-to-date. We still are a little overweight on the mid-cap part of the market. Small cap, we are underweight we're actually overweight on the short-term bonds. And then the next page really shows the outperformance of the international developed markets.
Which page?
That'd be page 11.
Okay.
Really outperforming everything on the US side. The only other thing that comes close is real estate and MLPs. And then looking over on page 13, the individual manager performances. If you look at the custom period, so that's fiscal year to date, the kind of holding up in terms of the large cap value, large cap, mid cap, struggling a little bit there. And the small cap, those two parts of the market have had a little bit more of a difficult time. But the best performance was the international equities, emerging market equities. High yield fixed income had a good custom period. But all the managers kind of holding in. If you look at year to date, month to date, you see a lot of negative numbers there. Less negative again on the international and the emerging market.
Just want to go to the page before. I just want to kind of point one thing out. So if you look at the custom period here for the fiscal year, all right, it's saying 3.6 up on the it's the middle, it's kind of the middle column there. You can just see though, Boyd Watterson fixed income and parametric both returned about 425, 424 for the custom period, but the stocks returned 346, right? Bonds actually outperformed the stocks. So having an overweight to the bond allocation really helped us so far in this fiscal year. So just want to point that out.
I actually thought you were going to mention that when you were talking about the first part of the presentation, how the stock market is so crazy right now, that would make, placement in bonds a safe bet for the moment.
So yeah, for the moment, the thing is that credit spreads are still pretty tight relative to treasuries. You've seen them widen out just a teeny bit, but not a lot. So basically what ends up happening is, in times of financial stress, the amount of compensation that you need to take corporate risk over treasury risk is very, very high. especially on the high yield. The good news is that a lot of corporations, you know, over the last like 5 years, right, when rates were a lot lower, 4 or 5 years ago, you know, locked in financing for an extended period of time. And I think the one that I always talk about is Amazon literally did a 0% bond deal in like mid 2020. Like 0% for 10 years. They don't have to pay anything. Like people just lend them their money. So but the other corporations did that. So their balance sheets are actually in really good standing. So that's why credit spreads have not widened out a lot. And even in the high yield space, they did things like that as well. So maybe they didn't get 0%, but they probably got like a 3 or 4 or something like that, which is, you know, not bad considering they have to refinance at 7, 8, 9 today. What is happening though, that I saw is that bankruptcies for small businesses are the highest that they've been in 15 years. And that's because businesses that can't hold inventory, you know, are having a tougher and tougher time with the tariffs. So the small businesses are getting hurt again. It's just sort of like, it's like COVID, but in a different way, right? The large businesses are fine, the small businesses are having a tougher time. Sorry.
Yeah, no. I was gonna skip down to page 18 unless you want to cover something else, Kevin. Just looking over the fixed income, part of the portfolio. You can see, you know, the bar charts, that we do have the highest percentage is in the 2 years. All very good quality. And then if you were to look at all the bond holdings, you know, our modified duration is 2.84. So overall, yield to worst of over 5%. Still holding, paper gains and with all the separate bond holdings, we're feeling very, very good about not only the positioning of the fixed income, but also the individual bonds that we own. And again, you know, having a yield to maturity and yield to worst of over 5% for such a modified duration is really good for us.
Just want to turn to page 28. That's one of the things I want to point out. So this is how quickly markets can change and how the change, the delta of change, I guess you could say, in a short period of time can end up affecting the longer term period numbers. So I want you to look at here, US large cap growth versus US large cap value. Now there's no question, absolutely no question, that in the last 3 to 5 years, that large cap growth has been a story, right? NVIDIA, Microsoft, Apple, Google, right? Like if you were not in large cap growth, like that was, you were underperforming, right? Well, look at large cap growth last 3 years here in the portfolio, okay? The last 3 years, our large cap growth holdings have had 3.07% increase. Large cap value is now 6.53. All right, so 350 basis points basically about performance on large cap value, even though value has lagged 2 of the last 3 years. Okay, it's lagged 2 last 3 years, but because of now the big divergence in this one, I mean, just look in the quarter, growth is down 11.36%, value is down 1.64, so 1,000 basis points about performance. But if you take that 1,000 basis about performance and you have to now, third of it goes into the first year, 30 goes the second year, 30 goes the so that sort of is the way that the math works. And just shows that again, these sort of things that the market are favoring can change very, very quickly. And as we've seen, obviously, the market center can change very, very quickly as well. But again, happy with the way that the portfolio is positioned. We did raise a little bit of cash, kind of rebalancing some of the mid-cap exposure that we had. But then and moving a teeny bit more towards shorter duration. But we're still going to be in the, I'd say 2.5 to 275 range on duration. Not going super ultra short.
And then one last page just to point out is on 31, it's just the projected 12-month summary. And we've always had, again, more about one of our, defensive Parts of the philosophy of our portfolio implementation is to, always trying to get that good, reliable and secure levels of income. And so, projecting 687,000 of income over the next 12 months definitely will help in the volatility, temper the volatility.
Brilliant.
We're not doing that. I'd say, again, I just wanna, I think just reiterate, the funding ratio is, you guys are doing great, the budget's obviously great, the amount of liabilities that are being paid out of the pension fund, we got the $1 million out before basically like this, which is, fortunate timing, right? But all these things are just helpful in terms of the way that we're, positioning the portfolio to deal with downturns. And, people forgot about 2022 as recently as December of last year, like 2020 never happened. Now all of a sudden it's like, oh yeah, remember 2022? This is, what can happen. And, for the first time yesterday, actually, the Barclays Aggregate Bond Index, which was up on the year, was actually down on the year as of yesterday. And so we could be a situation where stocks and bonds actually, are moving in tandem to the downside again, even though they've been uncorrelated, which they should be normally for most of this year.
I just have one question, and I'm trying not to be a
Please.
fatalist, but the way I see things going, we're in a position where our government is really looking to strengthen even more executive power. And there's really one way for that to happen, like in total, which would be some kind of armed conflict. So I'm just wondering whether those considerations have been looked at by anyone.
I would say absolutely. It's less so that I would say, and more so like if a trade war ends up to a full-blown conflict, because a trade war doesn't help any country, right? I mean, just China, just as an example, right? They need us to buy their stuff. And we need them to produce our stuff, like for the most part, right? Not that's, very, very generalist way of saying it. So it's like, if we have a trade war and now all of a sudden they've got all this stuff they can't sell, their economy is hurt. And we've got all, these people that have no supply of anything, our economy is hurt. Well, that's usually when like tensions start to rise, right? Because everyone starts blaming each other for something, and escalation, it can escalate. So those types of things, we certainly think a little bit more so than an internal conflict. I think at this point, again, it's still so far away, but you might see the pendulum swing the other way with the midterms and Democrats taking the House and the Senate. Possibility, still, again, it's whatever, 16 months is like an eternity in an economic cycle, in an election cycle, I should say. And so who knows, but that might actually quell some of the, fear that you have with that, if that actually happens.
But are we well placed if such a scenario was to?
I mean, stocks and bonds will certainly both go down in that situation, and that would be a very difficult thing, for sure.
The price of a bond might go down, but the yield might go up.
Yield would go up, yes, again,
So
we hold a lot of our
paper
bonds to
loss,
maturity. We hold a lot of our bonds to maturity, so
Right.
it would have a short-term impact for sure, and that's one of the reasons, again, we want to be short-term bonds. But then our reinvested yield would go up, but stocks would go down a lot, because something like that would not sort of enter into the conversation. And then, it's unfortunate, and these are things that we think about as well, is that, a global conflict today is much different than it was 100 years ago. The amount of, nuclear arsenal and, other things at the military's disposal is just, just unheard of, which is unheard of, 100 years ago, right? So those things are obviously very, very concerning as well. But the only thing that you can do to really hedge against any situation like that would be to be 100% cash. And that doesn't really make a lot of sense, from the standpoint of investing. for the longer term. And, you know, didn't make it through 2 world wars. And the stock market still, you know, kept going, the economy kept going, Europe was rebuilt, you know, Japan was rebuilt. So let's hope it doesn't get to something.
I mean, you gotta. Look, I mean, I hate to. Bash, you know, I'm not. Whether you're a fan or not of the president, but. As in term 1, I look at the people around him and. There's some, I think, less good actors, but a guy like Scott Bessent is a pretty level-headed guy. And as long as he's wielding influence, I guess he's the one who brought those CEOs into Trump's office. And there, you know, as long as he survives, like, I feel better about it. You know, if this guy
Peter
Navarro, you know, if he wins out, I think it's a different game, you know, something like that. So, you know, that's kind of what you hope is with Trump, who can tend to be a little bit more mercurial. You just hope that there's some people around him who can influence him appropriately, like any president, right? I mean, good advisors. I don't want to, so I'm not trying to be overly political on this, but I mean, good advisors and listening to the right people and getting the right influence in the Oval Office. So that's.
No, I think that was very helpful. And I don't know if you read this story, it was maybe like about a week ago, I think it was in the Wall Street Journal, where he went in with somebody else, I can't remember who, but basically it was like Lundnick and Navarro left the Oval Office and they rushed in there, like, and basically tried to get like a 5-minute meeting with Trump to tell him to pause the tariffs. And within 24 hours, he said that they were going to let you do that 90-day pause, right? And it's like, you have to be in the right setting, you have to get the right people in front of him, you have to, you know, get him at the right moment. And at least, you know, cooler heads have started to prevail, which is a positive sign. But the problem is, again, the waffling that we get every single day from an hour-to-hour basis is something that investors are not going to be happy with, and corporate leaders are not.
Sometimes it's just the flip confidence, you know, and
Yeah.
you know, hopefully you can look beyond that, and if the policy ends up being somewhat reasonable.
I think the best thing that could happen in the stock market is if Washington comes out with an actual agenda. If they actually said, here's our plan, here's what we're gonna do, here's how we're gonna execute it. I think that would quell a lot of, you know, fear. The problem is they don't have an agenda. It's ready, fire, aim. You know, it's like they do something and then they see the reaction to it and then they've got to react to the reaction. So that would be helpful. And I'm not trying to make this political either. So it's just, that's just the fact of the matter of how the messaging is coming out of Washington.
And, you know, look, it's, even though they've been there before and they came in more prepared this time, and clearly they came in more prepared between executive orders and tariffs, like immediately, and the border and everything. Like any newer administration that's taking immediate action, they're still learning to some extent, and you hope there's a learning curve here. And you know, and who knows, you know, maybe at the end of the day, there's some settling on the tariff front. That's what I think everybody wants.
100%. Yes.
So, yeah.
Comments, anyone on Zoom? Paul, Leland?
None from
Leanne? Okay. Interesting times.
Yeah.
I would just ask, at what is the catalyst? And at what point are we going to commit more money to equities?
Yeah, I was
You know,
expecting
I
that.
mean, what
We haven't
we're
talked
doing
about-
effectively is we're market timing now. And I'm not really a believer in that. So
Yeah, so again, I would classify it as risk reduction rather than market timing. And just clearly the risk is more so on the US side. We don't have supply chain.
So
We have-
what is it we should look for that is going to relieve that?
I would say,
situation?
yeah, we talk about that a
I just
lot.
think as a discipline, I'm sure you do, you know, what should we expect? If
Well,
we see certain items that happen,
you know, to your point, Paul, the market is a trade, quote unquote, trader's market right now because the volatility is high. And one day we're up 2%, the next day we're down 3%, the next day we're up percent. And so the movements are very, very big. And it's very hard to invest for the long term when there is this much, you know, volatility and this much uncertainty. So I totally understand how you're perceiving and viewing that. But one, you know, I would like to see valuations come down to at least average in the US market. And again, we don't even know what the earnings, you know, forecast is going to be for a lot of these companies if these tariffs continue. So that's assuming the E stays the same and the P comes down a little bit. We would want to leg more into US equities, absolutely. Most likely from bonds, I would think at that point. But you know, the big catalyst, I think, is really going to be a clear agenda from.
So are we talking about getting from 60 to 65? Is that what we're?
Well, we're talking about, you know, being on the low end of the range for US equities to a more
Okay.
like, you know, if we're going from 21 to 30%, basically in US equities, going to be more benchmark weighting in US equities. And just my experience and you know, my understanding of what's going on says that until we have a more, like, this isn't a, you know, a lot of market timers like to say buy the dip, right? Because that worked again in a 0% Fed liquidity inducing market. Anytime the market went down, if you bought it, it went back up, right? We're in a much different situation now. So I'd be, again, rather would be defensive and reducing risk just in this posture because, you know, my worry and just, you know, my experience and just historical experience with tariffs is that they do lead to recessions and even depressions over history. There hasn't been one time in history that tariffs have ended up being an economic stimulant. So until he backs away from this in a pretty significant way, you know, you are going to see a big hit to earnings, and you are going to see, unfortunately, a detriment to U.S. production, U.S. GDP. And those two things aren't something that I feel like, at least for the, you know, next few months, that we need to be increasing our U.S. stock exposure, especially at premium valuations. So, you know, you can look through the market perspectives a little bit too. It's like the equity risk premium has gone from 0 to 73 basis points. It's still not very, very attractive. You know, it's basically a toss up again between stocks and bonds. And the valuations aren't very attractive either. So those, I think, just coupling those two, well, really three things, because you have to, again, take in the policy, you know, situation that's going on too, doesn't lead me to think that now's the time to go more heavily into US equities. Even though recent history would say probably should, but I just feel like it really is a different situation now because it's not status quo in the globe anymore. This is a real changing of economic policy, global economic policy. And we have not seen this for 90 years.
So, can I say I agree with both of you?
Politic.
You know, this time is different is, you know, you could say that over and over, right? I mean, and I know, you know, that, when it seemed like it was different 5 years ago. It seemed like it was different, you know, 10 years ago, 15. So, you know, to Paul's point, I get it, you know, discipline, but, I mean, I tend to be a little bit more cautious anyway. But when you say, increase in US equities and most likely taken from bonds, what's the target rate on equities? Is it a 60-40 portfolio or is it more than that?
Maybe probably like a, 65, 35,
Yeah.
or like
Okay.
a 67 and a half,
Right,
32 and a half,
right.
somewhere around there.
Okay,
Would be,
Yep.
likely.
Yep.
It's not gonna be an 80-20 or anything like that,
Yeah.
it's gonna be somewhere like that, so.
and I know we have more to talk about on that anyway.
Yeah.
So,
Okay, other questions, comments? Anyone? Leanne? Anything?
I'll make some comments when we do the asset allocation discussion, if that's okay with you.
Yep, yep. Well, I think we're ready to move into that then. So that's a good
All right.
segue.
So I think the one thing that we can all agree upon is that there is a lot of disruption and chaos in the market. And in this case, it is by design because of policy as opposed to an economic shock. And hopefully, my hope is that because it is by design, that cool heads will prevail and come up with solutions that work. So the other thing, that I wanted to mention is that we are long-term investors and we should not get praised at what's going on. I mean, we should be concerned, of course, but we have to be thoughtful of what we're trying to do over the long term. And that is the reason why we do our annual investment policy statement review. So we haven't done it in 2 years because we took the time to take a very close look at our asset allocation and to really do a little bit of a deeper dive into what we should be doing from a long-term investment perspective. And I think, just to kind of bring us all back to our focus of what we're doing here, we, took a very close look at our liquidity position to make sure that we have enough money to pay all of our investors, our retirement participants. We have enough allocation in cash and cash flow generation, which is very important. We have our actuary come in every year. We had Milliman come in and validate that, in fact, we've reached the point of our discount rate that we're comfortable with, at least for the foreseeable future, and with the potential of upward pressure on interest rates. I think that, that we're secure, at least for the time being. Clearly, the markets have been volatile, as I mentioned, and our asset allocation, as Kevin and Becky just discussed, has been working in during these downward markets that we have been having the conservative go down less versus go up more asset allocation that we have chosen from a risk perspective. So it's always nice to see that these things have worked out as expected. And, when we look over the long term, our investment policy statement tells us to focus on the 3 to the 5 year horizons in terms of performance. And, over the 5 years, we actually have returned 9.67%, and over 3 years, 4.84%. So the 3 years a little under, but between 3 and 5 years, we probably have been meeting our discount rate targets. We have been, I shouldn't say probably have been. So at the end, it was determined that we should make just small tweaks in our asset allocation, and that was to change the domestic equity minimum. We increased the band from 21 to 29%. So by default, to Paul's point, we're going to actually have to have a little bit more exposure to equities if we're not there already. And we increased the target from 30 to 34%. So we are saying that we want to become a little bit more US centric biased, and we want to have less in cash because that would be the offset for that. Kevin and I have both worked on this over the course of the past year and a half, and we agree with all of these policies. We have presented them to the pension board and taken your questions and answers all along. So I believe that these IPS changes are no surprises, hopefully no surprises to everyone there. The only other thing that we did was we added some language on QDRO, qualified, I forget what that stands for, but when somebody gets divorced.
Qualified domestic relations order.
Thank you. And actually that is in our plan documents as well. We do have that outlined in there as well. So I'll stop.
By the way, it's a good thing you don't know what it is.
Yeah.
I know we have very few participants in our plan on that.
I know what it is. I just can't pronounce what I can't remember what it stands for, but I'll stop here, Mr. Chair, and answer any questions that anyone may have, if that's okay with you.
Okay. Questions, comments? We've been talking about this for the last few months and tweaking it. I think we're just ready to vote on moving it forward or having done our yearly update. Anyone?
Kevin, any comment on that?
So just that, once it's passed, we'll just need a signed copy for our, compliance department, and then we just put that into our third-party monitoring that helps monitor the IPS. And I think one of the things that I would say coming to the next meeting is I'm gonna bring forth some US large cap value managers. We do have, one right now. They're a little bit, they've been underperforming recently, so one that is more, I'd say, like dividend focused. And I'll bring some, maybe, 2 or 3 choices of our best US value managers that we have to fill the gap, I think, or partially fill the gap, I should say. That extra, 8% we would need to come up to the minimum compliance at least. The new IPS.
And just what we're going to vote on here is we vote to approve the investment policy statement as with the amendments and changes that were discussed. And then it goes to the town board.
Board of Selectmen.
Board of Selectmen to approve it also. So what we're voting on is to approve and send this document forward.
Right.
Question, are we on?
Sure, please go ahead.
Leanne, my question is just on timing. I can't help but I recognize this is a long-term investment strategy. And we're not, but it is ironic that we're talking about changing the a couple of the caps toward the very market that we just had a conversation about being incredibly unstable. Is it wise to implement this change immediately, or should we wait a month,
Well,
2 months? Isn't it gonna require us to buy some stock right now?
Yes, it would.
Yes.
Well, that changes obviously up to our investment advisor. They have full discretion. And again, we are investors for the long term, and I can assure you what goes down will go, in fact, back up, hopefully, while we are all here in this position of on the pension board and myself as a liaison. But yes, that's the intention. And again, I know it's scary at this moment to be thinking about all of these things when we see these markets in total disarray like this. And they've been so volatile, up, down, up, down, up, down. But we've put a lot of thought and effort into this, and I'm not afraid to do it. I think it'll be okay. It will be okay.
And we've been above and below from time to time anyhow, and we can still be there.
And just want to point out too, like, for example, this is just one period of time, but from 2003, okay, yes, the S&P fell by 50%, but a lot of value managers actually had positive returns over that time period. So it depends on like what parts of the market we're in. And I think, again, if we're in more defensive parts of the market, even if the S&P continues to wind down for whatever reason, let's just say, that still means we can still be protected even with higher equity exposure because you're in more conservative equities.
I would just like to say that the old investment saying is now is the toughest time to buy.
Yes.
And, think about over the past 50 years, 1987 and then 2000 and 2008 and 9, and even as recently as 22. We've gone through terrible periods, but the secular trend has been up. And over time, we just have to bet. We don't have to, but I believe we should be betting on US equities.
So just to put it on the table, I'll make a motion for approval of the IPS modification as presented.
Okay, that's a motion. A second?
So,
Second,
and I'm not trying to close off discussion,
No.
but it should be on the
No,
table.
should have had that first.
Oh, no, that's,
Further discussion? Anyone? Okay, then I guess we're ready to vote. So all those in favor? Aye. Any opposed? Any abstain? Okay, thank you. Thank you, Leanne, for all your work, and Kevin on all this.
I just have one, may I make one more comment, Mr. Chair?
Absolutely.
So I just wanted to let the pension board know that almost immediately following this meeting, Carl, Rowena, and I are going to be meeting with Pam Fleming of Reed and Reed and Reed, and we are going over
Reed and Riga,
Okay.
or
And
Reed and Reed.
and we're going to be going over our plan docs. You know, and I've been speaking of this over the past few months. Hopefully, maybe possibly if we're ready in May and or June, we'll be bringing back some draft comments to the pension board about our plan documents, and we're going to be going over those. It hasn't been done since 2008. So similar to what we did with the investment policy statement for the very first time, we're going to take a hard, close look at our plan docs for the defined benefit pension plan.
And help me out here. We switched to Reed and Riga from somebody else, right?
Shipman Goodwin, I mean, and I've used, so we don't want to badmouth anybody. Shipman Goodwin is such an excellent resource. They are a firm that you call them and they have so many lawyers. We just use them in the chief spear negotiations and went away from our town council to do that. But with regard to the pension restatement, we felt we were not getting appropriate service, and maybe it wasn't sexy enough case, or maybe it wasn't enough work. And we ended up calling around a little bit and ended up with Reed and Riga. I don't know if I mean, you'd have a conflict anyway, but if your firm did anything like that.
We don't.
It just so happens, I went to high school with one of Mark Ryan at Reed and Riga, but you know, it's a very well-known firm in the state. So Mark was able to refer us to someone within the firm. So that's who we went with.
Good. It's good that we're staying on top of that and,
Yeah.
you know, looking at it every so often. So good. Anything else? Any old business? Any new business?
I just have a quick question, and I may have asked this before, so I forget too much, I think. So I chair the board at Kerma, and I also chair the investment committee at Kerma, and you know, insurance company, obviously conservative, 60-40, but 60-40 bonds to equity. And they recently have been looking at some alternative placements, private placements, collateral loan obligations, CLO obligations that are just as high. Do we have anything that would allow it in our IPS that would allow anything like that? Or is that something we're not allowed to do? Because they're an insurance company, they have to undergo all kinds of reviews, and these are actually very conservative investments that you're reaching for a little bit more yield. And even though some of the private placements are not rated, I guess, or they're not open market, as long as you can do a pretty conservative review of them and end up with the proper yield. Now, I don't know if that is even anything that this board should consider, or if it's even allowed in the IPS.
I don't think there's anything specifically prohibiting alternative investments. There's stuff that prohibits like cryptocurrencies and direct investments in, you know, like owning a building, owning a drilling well, things like that, private placements. But nothing that would say if we have a hedge fund, CLO fund, private debt fund, whatever it may be, we certainly could have a small.
I mean, I'm sure Morgan Stanley has all kinds of resources.
We have the largest alternative, investment platform
Sure.
on the street.
And I'm sure that. And maybe for discussion purposes only, you came back and said, if you were to look at this, it's basically almost a AAA rated or, investment,
Yeah.
even though it's alternative.
So, yeah, a lot of people have been putting money into private debt. That's like the biggest, I'd say, allocation that people have sort of migrated towards over the last few years, and that's because middle market banks aren't lending to smaller companies, so they have these hedge funds that are doing it, and they sometimes own the companies that they're lending to, so they have a little more control over, the leverage of the underlying entity and what the business is and all those kind of things. The only thing I would say in terms of just allocation, no matter what kind of private or illiquid investment we had, it's a 7 to 10 year commitment usually.
Yeah, right.
It's a long-term commitment. So whatever if the board ever decided to do something like that, we would just have to make sure that the rest of the portfolio was generating enough liquidity that we would never be forced to sell that private investment in a very inopportune time. Because that is where a lot of the, I'd say, negative kind of outcomes come from those types of things. And this happened in 2008, like a lot of the endowments like Yale and Harvard, to get liquidity because they were so heavily invested in alternatives, they were like over 50% in alternatives, had to sell a lot of these at discounts of like 60, 70%. And that's what you just don't want that.
Right.
So just making sure that the rest of the portfolio was generating enough cash and liquidity that we can continue to operate without having to worry about that. I'd say that some of our clients do that. A lot of them do not. And that's just because the illiquidity issue is I think too much for them to overcome. But certainly willing to discuss that if that was ever appropriate for the.
It may not be.
Is that an asset class that?
It's an
not-
asset class,
But it's
yeah.
not in our list of asset classes, so
So
in
we'd
that
have
way,
to-
you're
we
not,
might have to-
it's not part
to
of
add
our.
it. I mean, the way that like a CLO would be classified as like part of the fixed income or debt sort of structure. Like the word private equity, I would put that more towards the equity side, things like that. But we could probably even, create an extra alternatives asset class into the IPS if we were ever to think about doing anything like that.
Just bring it up for discussion. I mean, insurance companies are doing it. So.
Yeah.
When I see that, I'm like, they have to invest conservatively.
And, a lot of those now are the due diligence on the CLOs and everything, because like that was part of the problem in 2008, right?
Yeah.
So the whole rating and due diligence of those CLOs is a lot more stricter and conservative than it has been in years past, so.
Okay.
Law is a lot better.
Good. Anything else? Motion to adjourn?
I'll make the motion.
Second. All in favor? Aye. So adjourned. See you on May 22nd.
Thank you.